MNP, and they will be doing a presentation on business planning through a crisis, sharing information about programs that are available by government, but also information that business need to know about deadlines, how things need to be filed, and other tips that business really need to know to get a firm foundation beneath them as they plan to cope with the effects of COVID. It was an interesting point that the Deputy Minister of the Office of Business made this morning, that there's some talk about post-COVID and as we move through, but we are at a time with COVID that will be lasting over an extended period of time. So we certainly need to change the way we think about doing business, change the way that we are running our businesses, and evolve with the information that we're being given on how to operate safely and try and stay in business to see as things go along. So I would welcome Greg and Wanda, and thank you so much for being here with us today to share this information. And please begin.
All right, well, thanks for having us. We do have a fair bit of information to go through. We have 45 or 50 slides and scheduled for an hour, and I'm sure that we'd like to leave a little time for some questions. So we're gonna hoof right through it, I think, for the most part. So feel free to type the questions down the side as you're going, and we will try to address them for what we know, which is, I guess, sort of the first thing is, these things are evolving every day. So based on the presentation, and I missed anything that happened today, what Minister Trudeau had up his sleeve today for us. So we're probably out of date already, but we're going to give you what we know to date, and then see if we can answer some questions for you later on. So as we see, Wanda and I, Wanda works out of our Dartmouth office as a principal down there. And you're going to be lucky enough to actually hear her more than me during the day, so that's good for you. But we're both with MNP, and MNP is relatively new to the Nova Scotia and Atlantic Canada market. We merged in January 2017, and we were WBLI prior to that. So we've also since then expanded into Sydney, and merged with two firms in the Sydney area, and I don't know the other ones are public yet, but there's more to come. So stay tuned, and we're growing in Atlantic Canada. I'm not going to bore you with all the other stuff that's on that slide. You can read that on your spare time. But we are a good size. We're the fifth largest accounting firm in Canada. And with 70 offices and over 5,000 people across. So a little different than we were as WBLI, and we're certainly enjoying the resources that have been made available to us. So it's been a lot of fun over the last couple of years. All right, so let's hop right into it. So the agenda for today are pretty much as what you might expect there. We're going to talk about all those things. Usually the most questions are around the CEWS or CEWS or CHOOS or whatever you want to call it. So most of the presentation is on that, but we do have some other things we will go over. So the first thing we'll talk about is tax filings. Wouldn't think that this is a confusing thing, but there are some confusion there. Do you want to pop to the next slide there, Wanda? So here's a little thing that you can refer back to. I understand that Sherry was mentioning that this is actually being recorded, so you'll be able to come back and tell me what I told you wrong. But you'll be able to take a look at these. So basically, there's only a couple of things that were deferred. The T1s and the T3s, actually, their revised deadlines were pushed out a month. So what was your personal tax returns, which were due April 30th, and other years are now due on June 1st, on or before June 1st. So you get an extra month of May, which we as accountants just love having that extra time to do them. The rest of the things, for the most part, the dates really didn't change. Typically, for your corporation, you still have to file your return. The payments are deferred. So if you owe some tax, they're deferred until I think maybe I'm jumping ahead a slide, but the payments are deferred until the fall, until September. But you still should file those returns on time. Now, as well, though, they do say that there are no penalties for late filing, but yeah, I would still file those corporate returns on time if I were you. So yeah, that's about all I have to say on those things. I don't think there's much else there. That's pretty straightforward. So some other things that they've made changes to, one of the things is, as everybody's moving to electronic signatures over the years, CRA has been digging their heels in and not allowing us to do it. So for those of you who get accountants to do your personal tax returns, you probably noticed to get the T183s signed, they had to actually physically be signed and scanned and sent back and off to CRA. Now they're actually, because of COVID, they've been forced to sort of accept those. So this is a good thing. They say it's still only a temporary measure, but hopefully they'll realize how lovely it is to have those electronic signatures accepted. We don't really care too much about Quebec and Alberta at this point. So what's next? Your payroll remittances and source for deduction remittances, there's no extensions or anything there. Those and where you're withholding that from your employees, of course, they don't want you to not send that in to them in case they don't get it at some point in time. And it's sort of the same thing with GST. Now, again, with the GST, you still have to file it on time, but if you owe in the period, you can certainly push that off. Here it says no penalties on late file returns, but they are still due, so I'd still file them. And file your returns, particularly with if you have refunds, and they'll get them back to you as soon as they possibly can. An interesting note, though, if you do paper file your returns, those are going to set. So if you do have a refund and you do file it on paper, you're still not going to get that one back. So you should really do as much as you can electronically in order to help your cash flow. That might be the end of the first section. So I'll turn it over to you, Wanda. Take us away down this subsidy train.
Down the subsidy trail. Okay, so the first wage subsidy that Prime Minister Trudeau announced back in March was the temporary wage subsidy. So the temporary wage subsidy was announced to be a temporary 3-month measure which would allow eligible employers to reduce their payroll deductions that they have to remit to Canada Revenue Agency. And so an eligible employer is someone who employs one or more individuals in Canada, someone who had a CRA payroll program account on March 18th, 2020, and someone who pays salary, wages, bonuses, or other remuneration to an eligible employee. So eligibility is limited to Canadian-controlled private corporations that had a small business deduction limit for its last taxation year that ended before March 18th, 2020, an individual other than a trust, a partnership, all members of which are eligible CCPCs, individuals, partnerships, and registered charities, and a not-for-profit organization that's exempt from tax and registered charities. So with the temporary wage subsidy, it's calculated as 10% of the remuneration paid between March 18th and June 19th. The maximum subsidy amount is $1,375 per employee, and it's to a maximum of $25,000 for the employer. We should note that when there are associated corporations, associated Canadian-controlled private corporations, they are not required to share the maximum subsidy of $25,000 per employer. So to apply for the temporary wage subsidy, it's done through a reduction of the income tax component that's withheld from source deductions. There's no reduction for EI or CPP. If, as an employer, you fail to reduce your remittance, then it can be dealt with at the time when T4s are filed. And so even if you didn't reduce your remittance at the time of your payrolls through March and April and even through May, then at the time you file your T4s, it can be claimed at that time, and CRA will pay the amount to you or transfer it to your next year's remittance account. We've got an example here. We've got an example with 5 employees who earn monthly salaries of $4,100 each for a total monthly payroll of $20,500. So the subsidy in total at 10% of that gross payroll amount is $2,050, and that's per month. So over the designated 3-month period, the total subsidy received would be $6,150. So that is the amount that would be reduced from the payroll remittance each pay period. So after that wage subsidy was announced, the government came out with the Canada Emergency Wage Subsidy. And this subsidy is a 75% subsidy for employers. So what is this? What is the Canada Emergency Wage Subsidy? Well, it's a 75% wage subsidy. It is applicable on the first $1,129 of remuneration weekly, so limited to $58,700 per annum. And it applies a maximum benefit of $847 per week, which is 75% of that $1,129. The Canada Emergency Wage Subsidy was initially announced for a 12-week period running March 15th to June 6th, 2020, but we know last week that an extension was announced. We don't really have further information as of yet on that, but it will, like everything else with the COVID emergency response, it's changing daily or every 10 minutes. So we may have an update before we're even off the webinar and not know. With the Canada Emergency Wage Subsidy, there are several criteria to be met in order to qualify for this subsidy. And the qualifications and the legislation behind this are really quite complex. The key criteria are that you need to be funding an eligible employee by an eligible entity with qualifying revenue for a qualifying period, and the remuneration being paid has to be eligible. So what does this mean? Well, with an eligible employee, we are looking at a week that the individual was employed in Canada by an eligible entity, and it has to be other than someone who has not been remunerated for 14 consecutive days in the eligible period. And so because they would be eligible for the CERB or the Canada Emergency Response Benefit. And so this definition replaces a previous announcement that was made in regards to this. So just to update you that this has changed a little bit. Who is eligible? The eligible entities include individuals, trusts, taxable corporations, nonprofit entities, registered charities, labor organizations, agriculture organizations, boards of trade, chambers of commerce, nonprofit corporations for SHRED, and partnerships if all members are eligible employers. So with respect to the qualifying periods, we started out with 3 qualifying periods, March 15th to April 11th for period 1, April 12th to May 9th for period 2, May 10th to June 6th for period 3, and now of course we have an expectation of a period 4th beginning June 7th. So for each of these periods, we need to look at the wages during the period and the revenue period in order to qualify for the subsidy for that period. So in order to do the analysis to determine if you qualify, it's really important that the monthly financial statements for the entity are up to date. It's hard to do comparison analysis if you're not up to date with your accounting. So that's a really important part. And so for period 1, being the March 15th to April 11th period, the revenue period being looked at is March 2020 revenues. We would compare that to one of two options. It would either be the March 2019 revenues, or you can use an average of January and February 2020 revenues as your prior period or your prior reference period if you choose. We'll talk about this a little more. The required decreases in revenues for each of the 3 periods. It was 15% for March, and that's because we start at midway through the month. And then it's 30% for period 2 and period 3. So the revenue tests that have to be met in order to qualify for the wage subsidy is, as a rule, your revenue has to decrease by 15% for period 1 and by 30% for periods 2 and periods 3 to qualify. And so we're looking at revenue on a standalone basis, entity by entity, looking at the things that are normally a part of your revenue. It may include investment income like interest and dividends. And it would be in accordance with your normal accounting practices. There are things that would exclude as well, and that would include extraordinary items. It would exclude any wage subsidies you're claiming, whether it's the temporary wage subsidy or the Canada Emergency Wage Subsidy. And it excludes amounts derived from non-arm's length persons or partnerships. There are special rules with the revenue test where you have affiliated groups or a joint venture, or for an entity where non-arm's length revenue is 90% plus of the entity's revenue. In that case, there's a special look-through rule. There are also special elections, and that they relate to whether you use the cash basis of accounting or the accrual basis, and or your reference period eligibility. So that's whether you would use March 2019 as your reference period for period 1, or if you would use the average of January and February 2020. Just with a couple of notes on not-for-profit organizations, there are some things to think about if you are looking at whether a not-for-profit organization may qualify for this subsidy, but a lot of these are very similar even in the for-profit world. There are things to think about. With the revenue test, you need to look at what the accounting basis is, and so the accrual basis of accounting versus the cash basis of accounting, depending on your organization. Your accrual basis of accounting may appear as though your revenues haven't decreased, but if you look at a cash basis, it's obvious that the cash you are actually collecting in March of 2020 may be substantially lower than the cash you were collecting in March of 2019. So you need to look at what might work best for your entity. The catch with this is that whatever choice you make for your accounting basis, you have to continue to use that basis for the remaining periods. And so you need to be careful to make sure that you are making the best choice for your entity as a whole. Same situation with your period of reference. You can choose to use January or February 2020, the average of those 2 months, and compare that to March of 2020. You can also choose March of 2019 and compare that to March of 2020. Which works best for your entity, for your organization? keeping in mind that whatever basis you choose is the basis that you are going to have to continue to use for the remaining periods. Some things to think about with not-for-profit organizations that might be a little different than for-profit organizations. Oftentimes there's investment income, and so, you know, some of that needs to be included. You may have realized gains in your not-for-profit organization, and the treatment of those could be dependent on the gain itself, if it's on account of capital or not. Unrealized gains typically wouldn't be included in the calculation, but it needs to be looked at on a case-by-case basis because the legislation is so complex that really you get into areas where it's worth it just to check and make sure you're on side. And another consideration for not-for-profit entities is with budgeting. What about the budget? Are you looking at purposely reducing fees in your not-for-profit organization? I'm aware of a number of membership-based organizations whose members are out of work right now. And so they are looking at, do they purposely reduce their fees for, you know, a quarter of the year or half of the year to give their members the ability to not worry about those fees. And so that impacts their revenue and their ability to qualify for this subsidy. So there's lots of things like that that can even be considered. And even on a for-profit basis, I have a number of clients who've mentioned they're monitoring their revenue because as they're negotiating prices for sales and making deals for sales, they're aware of where they're sitting in their revenue, you know, with respect to the 15% decrease or the 30% decrease, you know, to not be, if they're going to not meet the 30%, they don't want it to be because they simply, you know, made an extra $1,000 on something and it was just, you know, a little bit off or, you know, something. They're focusing very much on that right now. So those are all good things to think about. Grant revenue is another point with not-for-profit organizations that there is an option to exclude it. And so that is something to think about as well. So we've got a few examples here we'll run through fairly quickly for the wage subsidy. So this is business A, and we're looking at whether it might be eligible for period 1 to qualify for the subsidy. So in period 1, we need a 15% reduction in revenue in order to get the subsidy. So this business had revenues of $100,000 in January of 2020, $140,000 in February of 2020, and $130,000 in March of 2020. And so their two choices for a baseline period would be March 2019, when they had revenues of $170,000, or the average of January and February 2020, which the average would be $120,000. So if they used the January-February average, they actually would have an increase in revenue, not a decrease. But if they use the baseline of March 2019, they've got a 23.5% reduction in revenue. So therefore, they qualify for period 1 using the baseline of March 2019. Important to keep in mind that once they choose that as the baseline, they have to continue to use that baseline in the next period. So for period 2, they would have to compare to April of 2019. For period 3 in May, they would be comparing May 2020 to May of 2019. Another important item to note is that once you qualify for a period, you then automatically qualify for the next period after that. So if you qualify in period 1, you do automatically qualify for period 2, regardless of what your calculation is in terms of the revenue test. Business B here for period 1 had revenue in January 2020 of $100,000, $140,000 in February of 2020, and $105,000 of March 2020. Their baseline options would be their revenue in March 2019, which was $115,000, and their average January-February revenue of $120,000. And so their March 2019 baseline gives them an 8.7% reduction, and the January-February average gives them a 12.5% reduction. Neither of those meets the requirement of 15%, so they don't qualify for period 1 of the wage subsidy. So with the subsidy, how do we calculate it? So there is a formula, there always is with CRA and with funding. The calculation is determined on an employee by employee basis. And so the formula is on the next slide. And so the amount of the subsidy we'll work through here in a few minutes. So it is the greater of, the least of. So it's kind of a little weird. The first few times I worked my mind through this formula, it strikes me as funny, but it's the greater of two options, option A and option B. And option A has a least of formula, and this is applying to arm's length employees, where 75% of the remuneration paid is the first point, 847, which is the maximum per week, is the second point, and a nil amount for non-arm's length employees is the third point. So the lower of those three amounts is the amount under option A. Option B, the amount is the least of eligible remuneration paid to the employee in respect of that week. And so this allows 100% subsidy if this is the least. The second point is 75% of their baseline remuneration, and the third point is the $847 per week maximum. So the least of those three amounts becomes option B. And so your subsidy amount is the greater of option A and option B. So the baseline remuneration is the average weekly eligible remuneration paid between January 1st to March 15th, 2020. So it's the average of the weekly pay before we hit the COVID situation. And so this is relevant because I can't even say it, a non-arm's length employee will never exceed 75% of the baseline remuneration under the subsidy. But an arm's length employee can exceed 75% of the baseline if their remuneration increases. So this is preventing employers from giving a payroll increase to non-arm's length people now that there's a subsidy in place. So we've got an example here of the wage subsidy calculation, and this gets a little bit easier to understand once you start seeing numbers with it. So for our first example, we will look at both an arm's length and a non-arm's length individual, two individuals. They are both getting a weekly baseline remuneration. That was during January to mid-March. They were getting paid $2,000 a week. Currently, now that we're in the COVID pandemic situation, they are receiving a weekly remuneration of $800, both individuals. So for the arm's length employee, the subsidy that the arm's length employee is eligible for is calculated as the greater of option A, which is the least of 75% of their remuneration paid. So 75% of $800 or $600. The maximum benefit that they're eligible for, which is $847, or nil if it's a non-arm's length employee. And in this case, it's an arm's length employee. So from those three options, $600 is the least. For option B, the amount is the least of the eligible remuneration paid, which is $800. 75% of the baseline remuneration, so 75% of what they were paid weekly during the period January 1st to March 15th, so $1,500, or the maximum benefit being $847. So the least of those three is $800. And so for the arm's length individual, the greater of option A and option B is $800. And so that's the maximum subsidy for that arm's length individual. And so the subsidy is a 100% subsidy for the remuneration being paid. For the non-arm's length individual, their options are still the same, but it's the least of the 75% of the remuneration paid, or $600, the maximum benefit being $847, and because they're a non-arm's length employee, nil, so 0 is the least for option A. Option B, they're eligible for the least of the eligible remuneration paid, which is $800, 75% of the baseline remuneration during that January 1st to March 15th period, so $1,500, and the maximum benefit, which is $847. And so the least in that section is $800. And so the non-arm's length employee is also going to receive the greater amount, which is $800. So will also receive a 100% subsidy. And the reason that they're getting subsidized 100% is because their current remuneration is lower than their baseline remuneration. Now, in the next set of examples here, we've got an arm's length employee and a non-arm's length employee who were paid $700 weekly in the baseline period, January 1st to March 15th, but now, during the COVID pandemic, they're being paid $1,200 weekly. And so if we work through the options and the calculation here, the least of 75% of the remuneration paid is $900, but that's more than the maximum benefit of $847. And this is an arm's length employee, so the non-arm's length calculation doesn't apply. So the least amount in this section would be $847. In section B, they're entitled to the least of the eligible remuneration paid, which is $1,200, 75% of their baseline remuneration, which is $525. So that's 75% of the $700 a week they were paid pre-COVID, or the maximum benefit of $847. So the least amount under option B is $525. And so for this arm's length employee, the wage subsidy will be the greater of those two amounts, so $847. So that works out to be a 71% subsidy for that employee. For the non-arm's length employee, same baseline remuneration and same current remuneration, but the calculation works out differently because it is a non-arm's length employee. So the least of 75% of the remuneration paid is still $900, and the maximum benefit is $847. But in this case, the non-arm's length employee has the nil amount as the third option here. And so the least of those three amounts is nil. In Part B, the least of the eligible remuneration paid is $1,200. 75% of the baseline remuneration is the same at $525, and the maximum benefit is the same at $847. So the greater of those two amounts is $525. So the maximum subsidy to the employer for that non-arm's length individual would be $525, or 44%. And so that's how they're limiting the ability of an employer to pay more to non-arm's length employees during the COVID crisis. So the eligible remuneration includes salaries, wages, and commissions. It must be paid in respect of the week in the qualifying period and paid between March 15th, 2020 and June 6th, 2020, now to be extended past that. It does, at this point, it does not include dividends, severance pay, stock option benefits, or remuneration paid to an employee who was without remuneration by the employer in respect of 14 or more continuous days in the qualifying period. So a few provisions that exist. There's no doubling up with eligible remuneration. So if an employee is employed by multiple persons in a non-arm's length group, all of the employers can claim a subsidy in respect of that employee, but the total subsidy is still limited to the maximum of $847 per week. And if you are an employer who's eligible for the temporary wage subsidy, then your subsidy under the Canada Emergency Wage Subsidy will be reduced, regardless if you reduced your source deductions on those payrolls. And if you didn't, that's okay. Remember, you still can claim those at the time of filing your T4s. It's just going to take some time to get to that point. The amounts are reduced by employee EI benefits under a work share program. And with the wage subsidy, the government is proposing a 100% refund for employer paid contributions to EI, CPP, and the QPP, and the Quebec Parental Insurance Plan. And this refund is available on employer paid contributions for eligible employees for each week throughout which those employees are on leave with pay, and for those employees that the employer is eligible to claim the Canada Employment Wage Subsidy. And so an employee is considered to be on leave if that employee is paid by the employer but does not perform any work for the employer. With furloughed employees, so employees on leave, the subsidy is increased by the employer portion of CPP and EI for employees on leave with pay. And the CPP and EI must be part of the normal remittances. For rehiring of employees, an employee would be eligible if they are not without remuneration for 14 or more days in the qualifying period. So this is why many employers rehired their employees retroactive to March 16th in order to qualify for the wage subsidy. And any retroactive remuneration must be paid before applying for the wage subsidy for the qualifying period. Applying for the wage subsidy, the application portal opened on April 27th, and you can apply for the subsidy through the My Business account on CRA, or through the Represent a Client portal on CRA. There is also an online application form on CRA's website. As an employer, you must maintain records demonstrating the reduction in revenues, as well as the remuneration paid to employees. And with this, it's really important. There are penalties that can apply with this. We'll talk about them in a few minutes. So it's really important to make sure that you're comfortable in your demonstrated reduction in revenue in order to qualify. We don't want to be trying to fit into a box we don't fit into. I do know I have some clients who applied for the wage subsidy on April 27th, and they received their deposits, a couple of them yesterday and the day before. So the funds are starting to flow now with this program. When you're doing your application, you do have to attest to the decline in revenue and that the conditions of the subsidy program have been met. And it has been indicated that the minister may make information related to the CEWS application public. With the attestation, the person who has the principal responsibility for the financial activities of the eligible entity must do the attestation. So penalties. The penalties with this are pretty stiff. You would have to, if you apply for this and you don't meet the requirements, you would have to repay 100% of the subsidy. If you aren't eligible, they may issue a penalty, a revenue suppression penalty at 25% of the excessive subsidy claim. It may come under normal gross negligence penalties at 50% of the excessive claim, and there may also be third-party penalties, which would be the lesser of the gross negligence penalty of 50% or $100,000. So with this, what we've been having discussions about is that it's important to be sure that you comfortably fit into the revenue tests, and that you're covering your bases and not trying to stretch things so that you do meet the 15% decrease or the 30% decrease. If you're being reasonable in what you're doing and reasonable in what you're calculating, and keeping documentation of it, then that's going to help you should CRA come along to have a look at this. And I think that's the end of the wage subsidy chat. So Greg, you're back on.
Is that me?
It's you.
Okay. All right, so moving right along. One of the other wonderful things that they have come out with here, and this is really recent. What was the date on that? April 24th. I guess it's not that recent, but recent enough. Is the Canada Emergency Commercial Rent Assistance. I don't know what you'd call that for an acronym, but we'll go with CECRA. So what this does, if you can flip to the next slide, it provides a forgivable loan to commercial property owners for 50% of the monthly qualifying rent payments. So for April, May, and June. It has to be, the tenant has to be less than a $50,000 per month rental client, and the tenant needs to have a 70% drop in their revenues. So, any of these tenants that you have that are no longer allowed to work, professional tenants, hairdressers, all those kinds of people certainly would have a 70% drop in their pre-COVID-19 revenues, assuming that'll be calculated similar to the 15 and 30% drop, but we don't really know because the legislation is not out yet. So how this really works is that the tenant will be required to pay 25%. If you can flip to the next slide. The landlord will forgive or not charge 25% of the rent, and the federal and provincial government will loan the other 50% to the landlord. That loan can be forgiven if the property is mortgaged, it appears, and the owner agrees to reduce the eligible small business tenant's rent by at least the 75%. So that's the 50 and the 25 that they're giving up. We don't know many details about this, but basically that's what it is. So the rent is being shared between the federal and provincial governments for 50%. The landlord's kicking back, giving a 25% discount, and the tenant is responsible for the other 25%. So when that gets released, we'll know a little bit more about that program. But at this point, that's kind of all we know. I say that before I look at the next slide, but we don't have a next slide, so we're good. So moving on to the personal side, the CERB, or the Canada Emergency Response Benefit. So that is the thing they came out with fairly early on for people to be a little bit more comfortable who have lost their jobs. So it's the 2,000 per month that everybody has heard about. It's available from March to October, and there is a deadline here. So people who do want this and are qualified for it have to apply before December of the current year. So it's for people who've stopped working or have reduced their workflow. All right, next. So then there's a few other programs that are, some are useful, some are maybe not so much, but there's the Canada Emergency Business Account. Now this one is kind of a neat one, and the qualifications for this is pretty well, everybody who needs it can probably get this one. It's a $40,000 interest-free loan. It's run through the banks. Of that 40,000, 10,000 is potentially forgiven. And the interest-free is kind of a nice thing. So it's in order to help your operating costs. You got to be a little bit careful about this one. You can't use this to sort of put 40 grand down on your line of credit and refinance that. You can't take the 40 grand out as a dividend to yourself as an owner. You know, this is really to help you offset some costs of operating. So you have to have a payroll, and you have to have paid at least 20,000, but no more than $1.5 million on your payroll during 2019 to qualify. So that's pretty wide area there. You can repay it up to December 31st, and that's when the 25% loan can be forgiven. And there's no interest on that, as I mentioned before. Typically, you can apply for this right through your, if you go onto your bank's website, they can do that. The other two little ones, I shouldn't say little ones, the other two that are a little bit more for larger amounts, the Working Capital Loan Program, which is administered through BDC, that's basically a program that you'll have a government guarantee. We're similar to the Small Business Loans Act. So the government guarantee kicks in. Typically, you would need to be able to get that loan anyway. So it's a little interesting. I haven't had any experience. I don't know, Wanda, maybe you have or you haven't, but shaking your head no. I haven't seen anybody apply for this as of yet. And so I'm not really, can't give a lot of help with that one, nor the small and medium enterprise loans, but it's basically the same thing. It's through the banks. That one's through the banks. And it's, again, government guaranteed. So if anybody needs any more information on that, we can certainly look it up and help. And I'm sure across Canada, we have some people who have applied for these that we can give a little assistance with. But as of now, I don't know a lot about these other than they're government guaranteed loans for those that qualify. So now we're going to wrap that one. Oh, for those, if anybody's out there that's in, I did have a little note here. The one thing that has been missing in any of these slides is the agriculture sector. There was some announcements within the last week or so of some funding, but basically our understanding of that from my discussions in our agriculture niche across Canada is that the government is really trying to push agri-stability as the funding source for those clients. So if you're not into or not a part of agri-stability already, you might want to apply for that. It's kind of a situation where you get to buy the insurance knowing that you may need it. Typically, an event will happen and you don't have insurance and you can't buy it afterwards. Well, in this case, you can. They've extended the deadlines until July 1st, but don't quote me on that, although it's being recorded, so somebody will. But I believe it's supplied till July 1st. And you can even apply, and if you decide not to go down that road later and pay the fees and so on, because you're not sure it will be a big benefit to you, you can do that. So anybody on the ag side should really look at AgriStability as a funding option to help them during this time. Sorry, moving right along. Where are we at? 252. Oh yeah, I only have one slide left. Awesome. So some of the other things that you can think about are listed on this slide. Then I'm just going to walk through them quickly to tell you why they're on that slide. I guess the owner, I'm not really sure why owner remuneration strategies on there, except for perhaps qualifying for subsidies and so on and so forth. But that's a dangerous game to play, because if you're doing something to fit in that box, as Wanda spoke of earlier, they will have a dim view of that. The payment of the tax-free capital dividends account. So quickly, what a tax-free capital dividend account is if your corporation has incurred a capital gain over the years and you haven't paid it out already, 50% of that gain is a non-taxable transaction. To get it out of the company on a tax-free basis, you have to do what's called a capital dividend account. For that, the reason why we're saying pay those out now is at some point in time, the government's going to realize they have to collect some more money to pay for all these programs. And by doing, there is some concern that the government will do away with this tax-free capital dividend account. So if you have one, you should pay it out prior to the next budget for sure, because that ability may disappear. The triggering capital losses on investments, right now, is if anybody's in the market, they know it's an up and down world, but more down than up. So if you've had some capital gains over the past 3 years, you may want to trigger your losses that you have in there now. You can carry them back 3 years to offset the tax you paid in those years and generate some cash for you, and an opportunity to restructure your portfolio if you want. The only thing I would say, it's the next point anyway. The only thing I would say there is you got to watch is if you're triggering capital losses. So you say, that I like that share that I own, but it's at a loss situation. So why don't I sell it and buy it right back? I get my loss and I get to move on. Well, no, that doesn't quite work that way. Of course, Revenue Canada doesn't like that. So if you sell it, you got to wait 30 days and you have a loss on it. You got to wait 30 days to repurchase that same share. Now, what you can do is they note there, if you had RBC, it's down, you're going to sell it. You could buy TD, and that's not a problem, but you couldn't buy those RBC shares back within 30 days. Otherwise, the stop loss rules will come in and deny the loss. Transfer of a property from a corporation to the individual shareholder. I guess the reason I wasn't sure why this was on here, other than at the time, right now, we're probably at a dip in fair market value on pretty well everything. So if there was property that you would like to have gotten out of the corporation into your hands as a shareholder, typically that's going to generate some tax somewhere. At this point, the fair market values probably could be argued that they're lower than they were 6 months ago, and it would be a good opportunity to move that out now at the least tax cost available to you. Estate protection plan, asset protection planning. Well, that's not a new thing. However, the risk of liability and potentially going out of business, I suppose, could be an issue there. So if you're sitting in a company that has passive assets, you have savings or you have investments, those are all subject to any kind of liability action to that company. As a normal rule, you'd want to keep those assets out of the company just in case anything bad happens. Well, maybe this bad thing happening now could be the thing. It may be too late to protect from that now, but it is something you should always consider, not just in COVID-19 days. The estate freeze and the thaw refreeze, again, it's all related to fair market value. If you haven't had an estate freeze, and what an estate freeze is you freeze the value of your corporation by a share reorganization. such that any growth from the time of the freeze passes on to the next generation. So you're deferring tax for a whole generation. Now's a good time to do it if you want to maximize that freeze, because again, it's a pretty good argument that the value of your assets have declined over the last 6 weeks. And if it's an operating business, we're not sure where it's going to go anyway for the next little while. So it's a good time to get that maximum deferral if it's something that you were thinking about. If you've already done a freeze, let's say last summer, when things were just sailing along and we hadn't heard of COVID-19, you may find that your freeze value is now higher than the actual value of your estate. So for example, you froze something at $120, it's now worth 80, and you pass away and it makes it back up to 100. You've done this freeze and you haven't been able to defer anything. So now's a good time to if you wanted to refreeze. So what we call a thaw and refreeze, you just do the transaction again, you freeze at the lower number, and you defer that additional gain off until the next generation, and it's their problem to deal with. I think I know that was quick and blowing through that, but we're at 2:58, so we certainly don't want to go too far over. I don't see any questions, so I guess we're probably in good shape there, Sherry. You're still muted, Sherry.
Yeah, just trying to find my mouse. It disappears if I don't use it. That was great, Greg. I really appreciate that. And no, I don't see any questions in the chat, but if anyone does have one, please put it in there. I'm wondering if you could, I guess, explain a little bit about the difference between arm's length and non-arm's length. You talked a lot about that with the wage subsidy in particular. And are there specific criteria that we need to consider when determining arm's length versus non-arm's length?
Do you want to do that, Wanda, or do you want me to?
You can.
A non-arm's length party is typically a party from a tax point of view that has some control. For example, an owner of a business, they set their own salaries, so they're not dealing at arm's length. Somebody else isn't determining what that is, so they have influence, and that's basically what non-arm's length would mean, would be somebody who had some influence over that decision. So it's typically relatives, blood relatives, owners, but it's a bit gray, and it's a well used in the Tax Act, and it's always a discussion point as to whether somebody truly is arm's length or whether they're not arm's length. And to steal a phrase from Revenue Canada, it would be an individual case-by-case basis, but typically an owner and any relatives of the owner, to summarize it.
Okay. So when we're talking about the rent deferral programs that the government has offered, I guess, are there any tax benefits to taking advantage of any of them?
Less revenue. Less revenue, less tax. It's not based on tax. It's you're forgiven 25% of the rent right off the top. It's really more, to me, I look at it from the point of view as if you have a tenant who's shut down, chances are you're getting zero. If you're part of this program, at worst case scenario, you should be able to get 50% of the rent. Really what they do, these things evolve. They put these things out and they're working quickly. Like we have to give them a little bit of slack. We can't complain on them like we normally do, because they're moving much quicker than they normally do. But there's going to be holes. So they throw it out there and they do their best to cover the majority. Then they come back to review it, make some changes, whether they're administrative changes or legislative changes, such that they fill those holes in for those individuals who are eliminated unjustly. Yeah. And that's what we've seen with all the programs. For example, the TWS, the 10% for Indigenous businesses that don't withhold tax, they don't have the advantage to reduce their remittances to Revenue Canada, but yet there's no application form yet to be able to get that 10% back in funding. So again, they're moving towards that, and plugging holes, but it's a big job. It's a lot going on out there.
So as you said, they're working on it, and certainly through networks like ours in the chamber and other business associations, as we communicate with our businesses and understand the gaps, we're able to feed that back to government. So
well, MNP as well, we have a government relations group that are in constant discussions with the various different portfolios in Ottawa to discuss the holes and or what's good and what is needed to make these things work. So, and they are working with other organizations and so on and so forth to try to get the government to recognize these things. And there'll always be examples of things that slip through. They're trying not to have too many of them, but you know, it's tough because everybody's situation is different. If you're getting the wage subsidy as an employee and you're taking the CERB, that will be caught. The reporting on that is going to be through the T4 program, I understand, so that the employer will have to report whether your salaries were covered under this CEWS. And if that's the case and you get CERB, you're going to end up paying back the CERB. The other thing is that I didn't see in those slides that I'm afraid a lot of people are going to miss is that these are all taxable. So the $2,000 a month for the CERB, there's going to be some tax depending on where you're at on your yearly income come the end of December 2020. But you know, even at a lower rate of 25%, you're going to end up having to pay back $500 per that $2,000 a month. That's not withheld. That employees are not typically used to. And I'm not sure everybody really grabs that one because it's not something the Prime Minister's going to actually say at his cottage press conferences. You know, these are all taxable, both corporate and personal. So it's great. I mean, I'm not complaining about them. I'm just saying that people need to be aware that some of that's going back.
Well, those are all wonderful points, Greg. And we're so thankful to you and Wanda for being here with us today and sharing some really good tax planning advice and some insight into the programs. We will make sure that everyone has your contact information afterwards so that anyone who, you know, wants to follow up with you individually or anyone within MNP can get the information that they need from, you know, an accurate source. And I know you've always been great to, you know, help guide our chamber members in the right direction when it comes to some of these difficult decisions. So I guess I'll close with that. And I thank you both so much for giving your time to our membership today. So
No trouble.
Thanks a lot. Everyone have a wonderful day.
All right. Cheers.
Bye-bye.
Bye-bye.